Good afternoon. I'm Matt Cadnar from the Nebo team. I'm joined by my colleague Ben Inker, co-head of asset allocation here at GMO. Thank you very much, first off, for being with us today. This is going to be an investment-related Nebo webinar where we asked several of our Nebo advisors investment questions that were top of mind. So this is kind of a Dear Allocator webinar, if you will. So this is not Dear Abby, mind you. We are going to focus solely on investment-related matters. We'll leave the other stuff to some other folks some other day, certainly people that are more qualified than we are to answer those questions. If you do have any investment-related questions, you can drop them into the Q&A box. We'll try our best to answer them at the end. If we don't, we'll get back to you as part of our follow-up. All right, Ben. So you and I worked together for almost 20 years now, which is more than a bit frightening. We've done a ton of presentations together through the years. I've asked you, frankly, a gazillion questions during that time, which you patiently have answered. But I do think this is the first time I've ever formally interviewed you, so it's a little bit strange. But I think we can. I think we'll be able to pull it off here. So let's get started with a question from Rich Toscano, our good friend at Pacific Capital Associates out in San Diego. And Rich asked, if a client has no volatility limit and a long investment horizon, Nebo will often recommend 100% allocation to stocks. And while this makes sense from a math perspective and a return perspective, a little paranoid voice inside Rich's head asked whether or not it makes sense or it is prudent to be 100% allocated to stocks. And I certainly always respect little paranoid voices. So Ben, what would you say to Rich's paranoid voice? And in a related question, what would you have to happen for there to be no equity risk premium relative to bonds?
Okay. Well, those are both really good questions. So as Rich says, Nebo will often recommend 100% allocation to stocks, but it won't necessarily do so. There's really two key assumptions you need to be making for that long horizon investor for Nebo to tell you that the optimal portfolio is 100% stocks. The first one is that this is a client who really does care about the return on their assets. Somebody who doesn't really care about earning a high return on their assets will wind up in something slightly less than 100%. The other really key assumption that Nebo does have as a default, but you can turn off, is that asset returns over time are mean reverting, particularly for stocks. If you relax that assumption, you'll get something else. But from my perspective, I think neither one of those cases, the situation where the client doesn't really care about the return on their assets or an assumption that the world does not mean revert, are good assumptions to be making for that long-term investor. So just as a little bit of a reminder, what Nebo is it's a needs-based optimization engine, which is a wealth shortfall minimization optimizer. So what you do is you say when you're going to start caring about shortfall, that time is generally thought of as retirement, and I'm going to be using it as retirement there. And what Nebo is going to be trying to do is minimize the amount and the likelihood of shortfall relative to your risk target once you are beyond that date. And so for a prospective client who is far from that retirement date, Nebo will often give you that 100% equity answer. And the reason is because you've got so much time until you care about your losses. And with that time, you've got the flexibility to really care more about the return generation. So the first exhibit we have here is the optimal portfolios coming out of Nebo for two different TCRs, or target compound rate of returns. In general, we'd recommend a client with a long time horizon having a 5% real target compound return, which is the top chart on this page. But then we've got another one where if you had a client who really only cared about earning a 2.5% real target compound rate of return, you would get a different portfolio. So in these charts, you can see for that 5% target compound return, the chart is all blue. You want 100% equities for probably about the first 20 years of this client's glide path. Whereas for that 2.5% TCR, you start off wanting to have about 92% in equities. It stays there for a while and then gradually falls. So what would it really mean to have this long-term client who doesn't really care that much about the return of their assets? Well, to my mind, that's a weird case because even if you've got a situation where this money doesn't have an obvious use right now, if circumstances change, they are much more likely to change in a fashion where the amount of wealth in the future will matter more. And for any client for whom it is going to matter more, I really do think that the portfolio outcomes from that 5% target compound rate of return portfolio will be better. So this second exhibit shows the simulated outcomes from that 5% target compound rate of return portfolio versus a 2.5% portfolio. You can see they actually both have just about the same probability of success, where success here is defined by having your wealth be greater than $0 at age 95. So it doesn't really change the probability of success, which is very high in both cases. But for that 5% target compound rate of return, you wind up with more money at the median level. You wind up with more median wealth in retirement. Your high percentile wealth is much higher, and your very low percentile wealth, the worst 5% of potential outcomes, is a little bit worse, but not much. So unless you've got a client who is utterly obsessed with the downside case scenarios, it doesn't really seem to me that that 2.5% compound return portfolio is going to be better for them. Now, the other key assumption here is that equity returns are going to be mean reverting. Now, history is strongly suggestive of that. What we have here is an exhibit showing the volatility of both equity and bond returns as time expands. We've got these dotted lines in red and blue, which is what these returns would look like, what these volatilities would look like if markets followed a random walk. And then in the solid lines, we see what has actually happened historically. And you can see neither bonds nor stocks have been well characterized by a random walk. Stocks have been generally less volatile than you would have expected if they followed a random walk, and bonds have been more volatile. Now, in the case of stocks, that's really been driven by the fact that valuations matter for stock returns. And you don't even need to believe that valuations themselves mean revert in order for valuations to matter. If you've got a stock market that is trading at a low PE with high dividend yields, those high dividend yields and low PEs will give you a higher return than a highly priced market, even if valuations don't revert. The case for bonds is actually a little bit more complicated. The math is a little bit more complicated. Martin Tarley and James Montier in a recent paper wrote about why bonds have been more volatile than a random walk would suggest. And if you're really interested, take a look at that. But the net result is, for anybody with a long time horizon, stocks remain more risky than bonds, but by a much smaller amount than a mean variance optimization or an assumption of a random walk would suggest. Those dotted lines suggest that even at 15 years, stocks are about 2.5 times more volatile than bonds. The reality is it's only been about 1.5 times. And so that means for somebody with a longer time horizon, stocks do get less risky over time. If you don't have that assumption, if you assume that those dotted lines are going to be what the world is going to be like in the future, and you tell Nebo that is your belief, you are going to get a different answer. So without this assumption of reversion to the mean, what you see is, for that client, even looking for a 5% real compound rate of return, they start off not at 100% equities, but only at about 80% equities. So the mean reversion assumption is a key one, and a random walk assumption, which is actually built into most Monte Carlo assumptions because it's the easier thing to do, will tell you stocks are really risky and you should not have a 100% stock portfolio. But we think pretty strongly that is a bad assumption to have. So why do we feel as strongly about it as we do? Well, a lot of this is driven by what we have seen historically, and the rest is frankly driven by behavioral finance features that seem to be broadly true for human beings. So we don't know the true fair value of the stock market. But Robert Shiller, Nobel Prize winning economist, pointed out in the early 80s that while we don't know the future and don't know what the stock market is worth now, we do know the past, and we can come up with a clairvoyant fair value for the stock market if we go back far enough in time that we have a significant future history. So in this chart, we've taken Shiller's basic idea and said, where we've got the next 50 years of dividends, we know what the fair value of the stock market was. And that's that red line turning green as we start to have less than 50 years of data. The key point here is that the volatility of that clairvoyant fair value is only about 1% per year. Stocks are worth the present value of their future stream of dividends, and that future stream of dividends has actually been really stable. The volatility of the stock market, on the other hand, has been quite high. It's been almost 18% per year. And it's hard to have a world where the stock market is that volatile and the underlying fundamentals justify it. What we have seen historically, and you can see with this blue line going up and down relative to the red and the green, is that sometimes stock investors are greedy and they push up the price of the stock market. Sometimes they are fearful and they push down the price of the stock market. But the underlying value is so much more stable. So in order to not have a mean reverting stock market, we either need the volatility of the market to be a lot lower, or we need the volatility of the future fundamentals to be a lot higher. In the case where the volatility of the market is a lot lower, well, then your simple mean variance optimization would probably say it's fine to own stocks because they don't look that volatile. The world where you really wouldn't want to own stocks is where we don't have mean reversion and short-term volatility turns out to be the right guide for long-term volatility. Let's imagine what such a world would look like. So we've got a volatile stock market, and it's going to be justified by the underlying cash flows being really volatile. Well, that world has to be a really volatile world from an economic perspective. This chart shows the volatility of 10-year GDP growth in the US. You can see it was quite high there in the Great Depression and in World War II. It has fallen quite substantially since then. But if on average volatility has been around 5% since 1900, that has coincided with a world where the volatility of fair value for stocks has been about 1. So in order to have a world where the volatility of stocks is a multiple of that, we would need GDP volatility to be much higher than we've seen historically. And in fact, what we have seen is that the volatility of GDP has substantially fallen over time. This makes a lot more sense because the economy has become much more service-oriented. We have a lot of automatic stabilizers in government spending, which helps cushion downturns. And what we would need is to see a huge increase in the volatility of GDP to make stocks as volatile as the short-term volatility implies. So I just don't think that that is likely. And from a behavioral perspective, in order for stocks not to mean revert, we need to have it be the case that investors don't respond to periods where stock returns have been good for a while by reducing their required equity risk premium, and that they don't respond to periods when the stock market has just fallen by demanding a higher equity risk premium. I've been in the investment business for 30 years. I can tell you I have never come across a single investor, myself included, Jeremy Grantham included, who doesn't do a little bit of that. Whenever the stock market has been doing very well, we come up with little ways to justify why the stock market's worth a little bit more than we thought. Whenever the market has been falling, we tighten up our assumptions to effectively require a slightly higher equity risk premium. And if we do that, and we're famous for being contrarians who don't care about what the stock market is doing, I'm not sure who does. So behaviorally, I think mean reversion is very, very likely to be there. The other thing that is very, very likely to be there is an equity risk premium. The other key assumption, which is built into Nebo, but you could override, is that there will be an equity risk premium. The default assumption in Nebo is that stocks will deliver around 6% real and bonds will deliver around 2.5% real. Now that is informed by US history. If we take a broader look and look across all of the countries for which we have good long-term data, that might be a little bit optimistic. The average country has delivered a long-term real return from stocks of about 5 instead of 6. Now, the ones that have done the worst have tended to be countries that have lost major wars or been invaded. So hopefully that won't happen too often in future. But let's assume that the US history was not apposite and you should do something closer to historic norms. Even in that case, you would want to assume a substantial equity risk premium because there are no countries that we have good long-term data for which stocks have not delivered a materially higher return than bonds and cash. And that makes a ton of sense. There should be an equity risk premium. And the reason why is not simply because stocks are more volatile than bonds, but because of the times when stocks really lose you money. Stocks are most likely to lose you money in really bad economic circumstances. Think about a depression-like circumstance. And that is the time when investors are most likely to be losing their jobs or seeing their income fall. If they are a corporation where they are where they have the highest chance of bankruptcy, that is the worst time to lose money, and you should get paid for taking that risk. The good news as a long-term investor is those bad economic times do not last forever. So there really should be an equity risk premium, and as long as there is one, it makes sense for long-term investors to have up to 100% in stocks. Now, the one thing I haven't talked about here is the nature of your client. If you have a client who is behaviorally really scared and likely to make bad economic moves with their portfolio when bad things happen to their portfolio, that is a pretty good reason not to have 100% of your money in stocks. It's the right thing for the portfolio, but it may not be the right thing for that intersection between the portfolio and the client. And if you wanted to say, hey, for this client who is a nervous investor, I want to put a maximum of, say, 90% in stocks, the good news is it won't cost a huge amount of money. There isn't all that long a period of time where naturally you want to have 100% of your money in stocks. And even where you do, a 3.5% equity risk premium times 10% of your money is 35 basis points during that period of time. That's not nothing, but that is not a night and day. So I do think Nebo is doing the right thing by recommending a 100% equity portfolio for a client who has a long time until retirement. But it wouldn't be crazy to override that if your client was one that you thought was going to react badly if that portfolio had a tough time.
Thanks, Ben. That the stock volatility relative to clairvoyant fair value chart is the one that it always amazes me how investors can be 18 times more irrational than the underlying fundamentals. But Rich, we certainly hope that this will silence those voices in your head. If not, just reach out and we'll have a further discussion. But I'm going to switch gears on you a little bit to geopolitical risk and how investors can address geopolitical risk, specifically around countries like China and Taiwan. Should you avoid them, or if you own them, how do you discount those risks?
Yeah. So geopolitical risk is a really important risk to consider. But the way we tend to think about it is when you are thinking about a country like Taiwan or China, it's not a coincidence that they wind up in that emerging group of countries. For us, the key thing about emerging countries is they all have higher geopolitical risk. They have less strong institutions. There is more policy risk. There is more economic risk. There is more trading risk. In all of those countries, the charm of EM and the benefits of EM, when you think about it as an overall group, is that the emerging index tends to be less volatile than any of the underlying countries in it. The diversification is really important. And when you're thinking about the risk of investing in something like China, you should think about, well, there is some non-zero chance that I might lose all of my money. Now, that is true for any individual stock you invest in as well. No matter how wonderful the company is, there is some non-zero chance that that company is going to go bankrupt. What you want to have is diversification. It has made sense to invest historically in places where there was higher geopolitical risk because you're normally getting paid for taking that risk. And you certainly do seem to be doing so today. We've got a chart here of the cyclically adjusted price to earnings ratios of the US, the developed international markets, and emerging. And what you can see today, and this has been true on average for the last 10 years or so, is that the emerging market stocks are trading at a very substantial discount, certainly to the S&P, but also to developed international stocks. And a way you can think about that is the market demanding a discount for that geopolitical risk. And if that geopolitical risk does not materialize, if nothing really bad happens, those cheaper assets are going to give you a pretty good return. So what we would recommend doing is, by all means, do not have 100% of your equity portfolio in China. Don't even be, anything like that. But if you can have a diversified portfolio of risky assets, including assets that contain some geopolitical risk, that's what modern portfolio theory has shown is good, right? The point of having a diversified portfolio is that those idiosyncratic risks do not fall down to the bottom line. And that's true of geopolitical risks as well. So by all means, own a little bit of China. Lord knows you're getting paid for taking that risk today. Do not own a lot of China, because that risk then becomes not an idiosyncratic and diversifiable risk, but an intrinsic and non-diversifiable risk.
Okay, so moving from emerging equities to the other end of the spectrum, quality equities. How do you define quality, and is that absolute or relative to the sector?
When we look at quality, we are primarily looking at three basic characteristics. We want high profitability across the economic cycle, stable profitability, and a strong balance sheet. And one of the questions we get a lot is, which is the most important metric? Is there a single metric that you can use to define quality? And we don't think there is. It's that intersection, right? You can have a company that looks like it is high profitability, and indeed, Fannie Mae and Freddie Mac for a long time looked very highly profitable, but it was because they had incredibly levered balance sheets. And when something went wrong, it was very bad. We think you need that combination in order to be truly a high quality company. And the wonderful thing about companies that have those characteristics is there truly is less fundamental risk. I talked about the fact that the reason for the equity risk premium is because stocks do so badly in really bad economic times. There is one group of stocks that is more or less guaranteed to outperform in those economic disaster scenarios. That is high quality stocks. So quality is a really interesting feature to have in your portfolio. And we think it comes about when you have this nice combination of features for a stock.
And absolute or relative?
We look at that in absolute terms in the sense of we're not just looking for high quality stocks within a sector. There are sectors that are higher and lower quality, and the reality is those matter. You are not going to see a lot of healthcare companies going bust in bad economic times, but you may well see a lot of energy companies or anything highly cyclical going bust. So owning something that is sector neutral relative to an index is probably not the highest quality portfolio you can put together.
So we have our definition of quality, but quality can be defined by a lot of different ways. Are there any any metrics out there that people define as quality that you would specifically avoid?
So I think there are some which are problems because of data issues, and then there are others which are problems because they're conflating two different things. From a data perspective, ROE we think is a very potentially misleading metric. Return on equity is in principle what profitability is about, right? As an equity holder, you are supplying equity capital to a company. What you care about is the return on that equity capital. The problem is book value is a very bad proxy for that true equity capital. And as a result, ROEs can be pretty meaningless. You've got companies like McDonald's that have negative book value and therefore have a negative or non-defined ROE. Well, that wasn't very helpful in determining the quality. And you have some other companies that look like they have really high ROEs, but it's not true. So the first thing you need to do is make sure that anything you're looking at has reasonable underlying data quality. We do a ton of work on our return on capital estimates to try to get to something meaningful from an accounting perspective. Another thing that people tend to conflate with quality is low volatility and low beta. We don't like either of those measures because they are so subject to change. For example, beating my example perhaps as a dead horse, Fannie and Freddie for a long time were low beta and low volatility companies, but they were incredibly highly levered. So when that bad event occurred, it didn't matter that they were low beta. It didn't matter that they had been low volatility. What we're interested in is that safety in the bad economic circumstance, and we think anything that is more statistically based is more likely to give you a misleading result.
So obviously, GMO, we're big fans of value. We're big fans of quality. How do you think about those two? Do you want to own them separately, or do you want to combine them into a multi-factor model?
So for us, we actually do a little bit of both. If you think about the GMO quality strategy, which we've been managing since 2004, we do not compromise on the quality of stocks in that portfolio, but we are happy to overweight those quality companies that look cheap to us, and we don't feel obligated to own a high quality company if it looks really expensive. And we think you can combine the two and get good returns. And what we have seen is quality has outperformed over time, which in and of itself is a little bit weird. These are truly lower risk securities. The fact that they outperform in the long run is truly a market inefficiency, and perhaps the most striking market inefficiency we've seen in the markets. But value within quality has done even better. And value within quality has even helped quality's outperformance in bear markets, which is the periods of time when quality actually does all of its outperforming. So we think combining them can make sense, but when we're doing that in the realm of a quality portfolio, we're looking at value within quality. We will not compromise on the quality of stocks. If we find a really, really cheap company that's only middling quality, we're not going to put that in our quality portfolio. And for me, that is a key thing about understanding the actual characteristics of a portfolio that I'm treating as quality. It shouldn't be willing to compromise on the quality, but it doesn't need to look exactly like the standard factor. And with regard to quality and value, our view on on using quality in a value portfolio is we do think that this quality factor is mispriced. We are happy to have more quality in our value portfolios. And in fact, in general, what we're looking to do is have as much quality in our value portfolios as we can without interfering with that basic value characteristic to it. So we're happy to include quality with value and value with quality, but what we want to make sure for our portfolios is when we are expecting something to have certain characteristics, either being a high quality portfolio or being a value portfolio, we want to make sure that our attempts at alpha or our attempts at risk control don't cause the basic characteristics of that portfolio to deviate from the factor we're looking for.
Okay, so related to quality and value as a factor, how do you think about alpha relative to those factors?
It's a little bit different for quality and value from my perspective. Today, we really like value stocks. And the reason why is because value stocks are trading at a much bigger discount to the market than they normally do. When they trade at that big discount, they tend to do quite well, and they deserve to do quite well. But if value stocks are trading at a smaller discount than normal to the market, we think they're going to underperform. So the first thing about how we think about a factor like value is you don't necessarily need to own it at all times. I wrote a paper back in 2005 called The Trouble with Value, where I said, the problem is value is priced to underperform. And indeed, from 2005 to 2015, our asset class forecast said value in the US deserved to lose to growth. So from a factor perspective, there's something to be said for always having some quality in your portfolio. Maybe you don't do that in 1974 or 2000, which are times when quality was trading at a much higher premium than normal. But it always has that risk control feature. Value is a little bit different. However, when we're talking about the factor and alpha, as we think about it, what you need to do is make sure the thing you're calling the factor is as close economically to the idea you're getting at as possible. So for example, with value, I don't care what the S&P value index does, what the Russell value index does, what the MSCI value index does. I care about what we really believe is cheap. So I'm not looking to our factor beta to somebody else's definition of value. But when it comes to our definition of value, that's where we have to make those trade-offs that I was talking about. And when we're looking at a quality portfolio, yes, we're happy to do things that we think will cause it to outperform, but we do not want to cause it to have that different characteristic. So value within quality is fine. Value with a bit of a quality tilt is a different portfolio. In general, when we're building our equity portfolios for things other than quality, which has this special feature, we're kind of happy to combine things and build something that has a combination of characteristics. And it's really only when we've got a factor that we truly care about from a risk perspective, like quality, or value today, where value is so cheap. Today, in our opportunistic value portfolios, we are not using the momentum and sentiment indicators that we normally do. We are holding aside a number of the factors we normally look at because value, as we define it, looks so cheap that factor return we think is really good. If it was less strong, we'd be more interested in doing things to try to add alpha relative to the factor.
Okay, Ben, last question for you. I'm going to turn it over to you. Is there an asset class that you really love that you haven't touched on, something that you want to talk about, kind of get it off your chest?
Yeah, thanks, Matt. There is an asset class that we have quite liked for the last few years, which is suddenly getting some attention in the investment world, but we think still not as much attention as it really deserves. And that's Japan, and in our case, in particular, Japanese small cap value stocks. People have avoided Japan for a long time, and they've made the assumption that there's something wrong with how corporations act in Japan. And we think that that is a very behind the times look at what's been going on. If you look back over the last decade, Japan has been actually the region of the world that has shown the strongest earnings per share growth. And even if we go back over 20 years, it's still the case that Japanese stocks have delivered stronger overall growth than they have anywhere else, including the S&P 500. So Japanese companies have been doing better than you think. Another nice thing about Japan is it has been the major country around the world where value has done the best. Famously, value has had a tough time in the US since 2005, and while it's done better in the rest of the developed world, it hasn't been shooting the lights out. But in Japan, value has done very well for a long time. So if you're going to be in Japan, value has outperformed quite strongly. It has done so with less risk, so we think it's a great place to be in value. And then you've got the small cap effect. Small caps in general have done fine around the world. An issue we have with them in a place like the US is they are pretty risky. These are a low quality group of companies. They have a lot of leverage to them. And in bad economic times, a bunch of them are going to go bust. The nice thing about small cap value in Japan is most of these companies, the median Japanese small cap value company has no net debt. So it is very hard for them to go bust, even in bad economic times, and their underlying profitability is pretty good. So it's a pretty high quality group of stocks. It's quite a cheap group of stocks. And it's in a country where value has done very well over time. There's one last piece of the puzzle, which we think is underappreciated, and that is the valuation of the yen. The yen right now is stupid cheap. You can kind of understand why. Japanese interest rates are still around zero, whereas they aren't anywhere else on earth. But that has made Japan a really competitive place to do things. It is a very cheap place to go on vacation now. It is a very cheap place to manufacture things. And that means Japanese companies are really very competitive. What we've seen over time is companies in countries with undervalued currencies see very strong earnings growth. So Japan has seen strong past earnings growth. We think they are ripe for strong future earnings growth. It's a place where value has done well, and it's a place where small is pretty safe. So we like it on just about every measure. We love to have it in our portfolios and kind of shove as much as the clients will allow us. And we do think it makes a lot of sense for investors to be taking another look at.
All right, awesome. Thanks, Ben.
Thank you.
This is now our fourth Nebo webinar since last summer, and our focus has always been primarily on education, modeling your assets and the issues with Monte Carlos, sequence of return risk, behavioral finance, and now this session with Ben on investing. But what we've also heard from advisors is that after each event, they tell us, I wish we could have seen more of Nebo, the actual application. So in that spirit, I wanted to take you through a brief 5-minute tour of Nebo, the application itself. We really enjoy doing these demos to advisors of all sizes, from startups, one or two advisors per firm, to bigger ones. So if you think Nebo can help you, please don't be shy about putting your name in the Q&A box, and we'll schedule a live demo. All right, to start, Nebo's big idea, if you will, is that risk is not volatility. Risk is not having what you need when you need it, and then building portfolios that minimize this critical risk. Here we show the portfolio tab, where we build the client's portfolio given the current market conditions. To the right, we show the client's age, longevity, what returns they need from their financial assets in order to achieve their goals. Nebo takes very much a goals-oriented approach. The left side of the screen is the investment schema. So here we're using the schema from our fictional Acme advisors, where we customize this schema based on the advisory firm's capital market assumptions, their asset class building blocks, and ultimately their implementation. So we know the client's wants and needs, we know the tools or the investments that the advisory firm has to get them there, and then Nebo builds an optimal portfolio to minimize the critical risk that the client does not have what they need when they need it. Now, there's some really important nuances here as well. It's not enough to have a set of today's expected returns. Nebo needs information about the full term structure of expected returns over the life of the asset owner. And we can certainly provide some help and thoughts there. In the upper right, we show a typical term structure. You can see at the top, equities in blue, mean reverting from 7% real to the expected long-term average of 6%. Or at the bottom, in yellow, short-term bonds, mean reverting from approximately 0 real to 1.25 real. Below that, we show an output related to the efficient frontier. Unlike mean variance optimization, Nebo also tells you where you should be on the efficient frontier, how much volatility you need to bear to minimize shortfall relative to the client's goal. But the absolutely crucial consideration here is that volatility is the output. Volatility or risk aversion is not driving the allocation. Minimizing shortfall relative to the client's goal is what is driving the asset allocation. Now, Nebo is not a financial planning tool, but it does integrate with financial planning tools. Tools like Money Guide Pro, eMoney, Right Capital. We even have a client that has their own financial planning tool that Nebo can integrate with as well. Nebo's process is to invert the standard process. Instead of starting with a risk profile, Nebo starts with a return profile, what the client needs from their financial assets in order to achieve their goals, and then helps the advisor and the client better balance the returns the client needs to achieve those long-term goals versus the short-term risk aversion of the client. And the advisor can then use data to help guide the client through that process to achieve the right balance of the long-term versus the short-term. With Nebo, you can also create customized glide paths based on our multi-period optimization, minimizing shortfall relative to the client's specific goals. We then use that glide path to test the viability of the financial plan using Nebo's next generation Monte Carlo simulation engine. Ben touched on this before. Standard Monte Carlo simulations found in financial planning software assume asset prices follow a random walk, and we know that this is inaccurate, but they still use it. Nebo corrects for this, building the mean reversion of returns and accurate volatility term structures. And this has incredibly important implications for the proper analysis of the financial plan, as well as the portfolio you build. Nebo also has, on the investment management side, extensive model building capabilities. We can build multi-level models all the way from the asset class level down to the individual security level, reflecting each Nebo advisory firm's investment philosophy, their building blocks, and implementation. This is our CIO or PM dashboard, which contains the market views for each building block. This is what drives the expected return structure I showed you earlier. Now, this is customized for each firm. We make GMO capital market assumptions available to you over here on the left, but Nebo does not require their use. We are, of course, always ready and willing to share our investment views with you as our strategic partner and willing to help you think through any investment problems that you're encountering. But we have firms that use their own CMAs or their even combined CFAs from different sources. It's totally up to you. In the end, Nebo builds a target portfolio for each client based on our multi-period optimization and better definition of risk, all with a multi-level structure. These portfolios can be sent directly into rebalancers. We're currently integrated with Orion Eclipse and iRebal, and we're working on other integrations currently. Nebo's multi-level modeling capabilities can integrate with any rebalancer that will allow for an integration. And we have built Nebo with an incredible amount of flexibility in its architecture so that it fits as seamlessly as humanly possible within your tech stack, helping you save time, be more efficient, and more productive. Now that is a very quick tour of Nebo, and frankly, it pains me to do that just in 5 minutes because we're just scratching the surface. But to sum it up, one of my favorite quotes from a Nebo advisor said, "What Nebo's doing is revolutionary, like direct indexing several years ago." I love that. Okay, to wrap it up here, given the time. Ben showed you aspects of Nebo related to understanding and building portfolios. And this is a key component of Nebo, but there really is much, much more. Nebo is, at its heart, an asset allocation platform which enables advisors to build portfolios directly connected to the client's financial plan. By redefining risk, once again, not as volatility, but as not having what you need when you need it, Nebo is able to personalize portfolios in a way that frankly no one else can. Instead of putting your clients into cookie cutter model portfolios with Nebo, the client becomes the model. The client has a model, a portfolio personalized to their own unique needs and circumstances. Nebo balances the long-term return needed to satisfy the client's goals with the client's capacity to take risk. We test that using Nebo's next generation Monte Carlo simulations, which corrects for the significant flaws that we see in the financial planning software and their Monte Carlos. And these flaws, they distort the analysis of the client's plan to achieve their goals, and they critically cause the client to either change their lifestyle or change their portfolio, both of which are unnecessary. But Nebo just doesn't build better portfolios. Nebo helps you build a better business. We're integrated with major financial planning tools. We're integrated with rebalancers like iRebal and Orion, and are actively working on other integrations currently with rebalancers. And Nebo is also in the process of building out its own rebalancing and trading platform. That is something that's actively underway, and we hope to give you an update on that in the coming months. Nebo's flexible framework and open architecture approach to capital market assumptions and implementation allows you to preserve your investment philosophy, your investment preferences, while using Nebo's multi-period optimization tools, personalized portfolio creation capability, and next generation Monte Carlo software. All to increase your confidence and your client's confidence that they are in the right portfolio for the client's financial goals. Nebo takes the guesswork out of building plans and portfolios personalized to each client's own goals, and it does so efficiently. If you'd like to learn more, please reach out, schedule a demo, check out our website, www.nebo-gmo.com. We've built Nebo for advisory firms of all sizes, from the very large to the very small firms, and we would very much love to be your strategic partner, working with you and helping to create better portfolios for your clients and a better business for you, the advisor. Thank you for your time today, and I apologize that we did not get to any of your questions. Ben was on a bit of a roll there, and I didn't want to interrupt. But we will certainly follow up with you after the webinar. Thank you and have a good afternoon.